Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Clorox's stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. The Clorox Company is a global manufacturer and marketer of consumer and professional products. The company is headquartered in Oakland, California, and was founded in 1913, over 100 years ago. It went public in 1984 and currently trades on the New York Stock Exchange. The company's products are sold primarily through mass merchandisers, retail outlets, e-commerce channels, distributors, and medical supply providers. Its brands include its namesake bleach and cleaning products, Burt's Bees, Brita, Glad, Hidden Valley, Kingsford, SOS, Everclean pet products, and many, many more. Let's get started with the model. This is a large cap company, 23 billion market cap. They're trading at 180 a share and they have 126 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see the company's free cash flow doubled from 2017 to 2020. Net income is a profit and loss on the income statement. It's revenue minus expenses. That also grew a lot from 700 million to 939 million. Revenue is a sales for the company, and their best year was in 2020 at 6.7 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. And the difference between those two numbers is their gross profit. Below that is operating expenses. Then below that is operating income. They had their highest operating income in 2020 at almost 1.3 billion. Below that is the interest they pay in their debt. Then below that is other income and expenses. Then their pre-tax income, then their taxes. And the bottom line of the income statement is the net income, and that was the highest in 2020 at 939 million. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business, and that peaked in 2020. Then you have capital expenditures, which are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. Their free cash flow is growing each year, peaking in 2020 at 1.3 billion. With their free cash flow, they pay a dividend. They also buy back stock. Every year they buy back stock. 180 million in 2017, then 270 million, 660 million, and 250 million. When a company buys back stock, it decreases the shares outstanding, making your shares more valuable. They also added some debt in 2018 and 2020. The most important part of any business is their operating cash flow, and this company generates a good amount of operating cash flow. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit and loss. It's not actual cash. And to calculate operating cash flow, you start with net income, then you have to add or subtract the non-cash items on the income statement. Even though they reported a $939 million profit, they actually generated $1.5 billion of cash flow. Let's look at the capital structure. 1.2 billion of equity, 3.2 billion of debt. They're 27% equity, 73% debt. Their net debt is 2.4 billion, and their WACC is 6.2%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 26 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $23 billion. We divide that by 126 million shares. We get a calculated stock price of 187. They're trading at 180, so they're trading at a 4% discount. It is a buy, but it's really close to where they're trading at. Simply Wall Street is a little higher than me. They're at 200 a share, so they're saying the stock is 10% undervalued. This is the stock price the last 5 years. It was pretty flat for a while, but once COVID came and the demand for its products, their stock price really was driven up. But it's interesting to see the stock price has come down in the past couple of months. Investors are selling off up here and capturing gains, which is driving the price back down. This company raises their dividend every year. They were at 77 cents in 2016. They're up to $1.11. They pay a 2.5% dividend yield, and they pay out 59% of their net income and 43% of their free cash flow. They have a really low beta, 0.2, so the stock moves much less than the market. It's not volatile. The 52-week low was 157, the high was 240. The stock is trading below its 50-day and 200-day moving average, so it seems to be on a downtrend. About 1.5 million shares are traded each day on this stock, and almost all the shares outstanding are on float. 86% are held by institutions, and over 9% of the shares on float are shorted. If you invested $10,000 into this company 10 years ago, you'd be at $35,000 today. That's a 13% annual return. The biggest shareholder is Vanguard at 12%, then BlackRock, State Street, Wells Fargo, and Geode. Let's look at the financial ratios. The average PE in the market's 9, the median is 14. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 24.1, so investors are paying $24 for $1 of earnings. Price to sales is stock price over sales per share. They're at 3.4, which is a pretty good price to sales ratio. Price to book is stock price over book value per share. They're at 19.1. And the way you calculate book value per share, it's equity over shares outstanding. Equity is assets minus liabilities in the balance sheet, and they have $1.2 billion of equity, negative $1.7 billion of tangible equity, since they have almost $3 billion of intangible assets on their balance sheet. Interest coverage ratio is EBIT over interest expense. They can cover their interest payments almost 13 times. ROE is net income over equity. They have an amazing ROE at 79%. Current ratio is current assets over current liabilities. They can cover their current liabilities 1.2 times. And their current assets are $700 million of cash, $600 million of receivables, and $600 million of inventory. So the company does seem to be well capitalized. They had $1.3 billion of free cash flow, $370 million of working capital, and a $560 million dividend payment. So they have almost $1.1 billion of funding. The best way to look at ratios is to compare them to companies in the same industry. I've done videos of Coty, Procter & Gamble, and Revlon. And Clorox is right here. If they have a number in red, they're worse than the average. If they have a number in green, they're better than the average. So they're worse in all the price multiples. They have a good current ratio. They have the best ROE by far. They are about average in debt. And they're the biggest company of this group, bigger than all the companies combined. And they pay the highest dividend of the 4 companies. So to summarize, I have them trading at a 4% discount. But this is a pretty big company. It's been around a really long time, and they provide such an important product during these crazy times. Their Clorox wipes were selling for 10 or 20 times the price online in the beginning of the COVID pandemic because no one could find them in stores. I ranked their free cash flows 8 out of 10, their revenue 7 out of 10, and their ratios 4 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.